Welcome to the Cherry Beckert Tax Beat, a conversation about tax that matters.
Welcome to this edition of the Cherry Beckert Tax Beat podcast. Today we are talking about the opportunities, distractions, and issues companies are living through with cross-border activity. Companies of all sizes are doing business in other countries, whether buying goods and services from offshore companies or selling goods and services to customers in other countries. All businesses have faced considerable challenges and fast-moving changes this year. Joining us today to talk about cross-border activity is Nelson Yates, leader of our firm's international tax and transfer pricing services. So good afternoon, Nelson. How are you doing today?
Good afternoon. Thanks so much for being here. I'm excited. I think it's an incredible topic for our client base, specifically here at Cherry Beckert, when it comes to cross-border transactions, obviously with the backdrop of tariffs, but more realistically, just over the last 20 years, how everything anymore has some sort of international bent to it. So looking forward to a great conversation.
And as always, joining me, my partner in crime, Miss Sarah McGregor. Miss McGregor, how's life treating you?
Hey, Brooks, everything's going great. We're into 2026, and so tax season is getting started, and it's great to think about new first quarter opportunities and all the things that happen in 2025. We're going to have to put into tax returns soon.
Yeah. Well, yes, and Happy New Year to everybody. I guess I should say that. And happy tax season to Sarah. She's almost giddy. She's giddy with excitement.
That's it.
That makes one of us.
So Nelson has recently joined our firm, but comes with experience serving large multinational companies with tariffs, interest rates, I would say supply chain issues, changing economies, significant direction shifts from our government, and that's being polite about it, I would say. In other countries' governments, companies need to stay agile and focus on what is important. So, Nelson, let's talk about U.S. companies that have existing production facilities or distribution centers in other countries or are thinking about moving in that direction. So how about a basic primer on what is transfer pricing about and what should a CFO or business owner be caring about here?
Yeah, great. Thanks, Brooks. So simplest explanation that I've come up with to date is when there are related parties, an affiliate, a subsidiary, what have you, a brother and sister both own a company, right? And they are transacting business, and that business is going across an international border, the price, whether it's for a product, whether it's for a service, needs to be a price that is reflective as if those two people were unrelated, as if they had an adversarial relationship, like when you go buy a car, right? Unless you're buying your car from your dad who owns the dealership, you are in an adversarial relationship trying to get the best price, just like the dealership's trying to get the best price. That applies to cross-border trade between related parties. The price of the service or the good has to be priced at a quote-unquote arm's length.
And I guess just from my perspective, sometimes I would say many times people would say, why do I care or who cares? And the answer is we got two different governments, two different countries that both want to say there's the highest amount of profit in their country on this transaction. So, I mean, part of this is getting to an answer and hopefully, fair market values in the eye of the beholder, but hopefully,
right.
You try to get structure and build a case that gets to the most tax advantageous from an overall perspective for the client. But anyway, excuse me, I interrupted you. So
No, all good. You're absolutely right. Who cares, right? Who are the stakeholders in this transaction? Well, obviously, there's the two companies, right? They should have some sort of vested interest in ensuring that they are each being remunerated for the value drivers, the risks they're bearing in the given transaction. But from an external perspective, 100%, the revenue authorities of each of the two countries involved, or if it's a multi-party transaction, multiple countries involved, they want to make sure that their tax base is as big as their tax base can be based on the facts of the transaction at hand. So it's incumbent on the taxpayer to, one, very clearly identify where are their value drivers? Like, what is the thing that is causing value for this service, for this product? Where does that reside? Is it in the U.S.? Is it outside the U.S.? right? And document that and make sure that they understand that that pricing that's going on that service, on that product between these two related parties over the international border is being priced to reflect that. A great example is like if I'm selling a widget in the US to my German low risk distributor, my German distributor, I don't sell it to them at cost, right? Because one, from a tax perspective, that would be bad because Germany's higher tax than the US. But two, there's no third party that would say like, hey, look, yeah, I'll sell you something at cost. I don't care if I make a single dime on it. So one, factually, it's just not accurate as to what happens between unrelated parties. But also it gives you a terrible tax answer in a lot of intercompany transactions. I mean, especially when you look at what we're doing in the U.S. from having a 21% statutory rate, from having the FIDE regime that's available to taxpayers where they get a preferential rate of now under going in 26, I think it's 33.34% deduction, which gives them effectively a 15% and some change effective rate on certain streams of income related to cross-border trade. So realistically, having value in the U.S., which is the truth for most of our companies in the middle market, if they're U.S. headquartered, one, that's factually accurate, but two, they probably are getting a better tax answer out of it too.
So Nelson, you shared with us the example about selling a widget from a U.S. manufacturer to its German distributor, and that is a very common and something that's easily understandable, the price of a good, but that's not the only kind of intercompany cost we're talking about here.
No, not at all. I mean, I think the interesting thing about all multinational businesses, right, but especially in the middle market, I get it. Tax doesn't wag the dog, right? Our clients, they are founders, they are managing members, a lot of them, they are pursuing revenue where revenue opportunities exist. Makes total sense. With that, actually kind of puts the business case together in and of itself. A lot of the time, the strategy, the decisions around how are they going to market, how are they pursuing clients, how are they pursuing that revenue opportunity are all actually being made out of the US, even if they do have that German company or that UK company or that Singapore company. There's a huge amount of value that's still sitting in the US. I think we are, a lot of us, right, and I'm guilty of it myself, are stuck in the idea as to what's IP or intangible property or intellectual property. And we think things like, oh, computer code. We think of like the Googles of the world or the Apples of the world. And I can't tell you how many times I've had conversations with middle market companies or even large manufacturers sometimes. And they go, well, we just make stuff. Like, we don't, like, okay, tell me this. Would you invite your biggest competitor in and let them walk your manufacturing floor and you detail out your processes, your know-how, the strategy behind what you're making, why you're making it, and how you pursue revenue? And they would look at you like you're crazy. They'd be like, no, there's no way I would ever do that, right? Well, that's IP. That is value driving intangible property, and it's sitting where these decision makers are, which for a lot of our client base is smack dab in the US. So they should be rewarded or remunerated for that value.
So we have the know-how. It's also financing and services and those kinds of things as well that are subject to making sure that the pricings for these items is appropriate between competing countries. So the U.S. is not the only country that cares about transfer pricing. The local countries all have their views and rules and regulations on this.
They absolutely do. Local countries still abide by what's called the arm's length standard. Maybe they follow a slightly different rule set, but it's still trying to get at the same thing, which is what is the appropriate price as if those parties weren't related that they would price that good, that service for. You touched on some important things just real quick, like management services, right? So maybe it's not all IP driven like this important strategy, but the U.S. or the parent company does a lot of stuff for its subsidiaries. It should be remunerated or paid for some of that stuff. So they should be reimbursed their costs. Sometimes they should be reimbursed their costs plus. So, some sort of markup. All of transfer pricing under the umbrella of trying to get to what that price is really looks at a couple things. One, is it a routine sort of service, right? Like sort of lower margin, but hey, heck, we should be reimbursed for our costs. We should get a little bit of markup on it. Or is it really this non-routine, this effort that comes from entrepreneurial activities? Should they be remunerated or paid for that kind of? And that sort of sets the barbell between sort of low margin to like a percentage of profit sort of remuneration.
So is that German distributor just distributing and managing sales to known customers, or are they tasked with creating new markets, identifying new products, and being part of the overall value operation?
Exactly, Sarah. Mm-hmm. And you touched on something good, which is like marketing intangibles, right? Building and investing in a marketplace to build your brand, to build your name in a local jurisdiction, generates something intrinsic of value. That is an intangible asset that local country has generated, and they should be rewarded for. Not the same amount of money as they say the person that actually came up with the design of the widget and all the cool know-how and technology that goes into it. But hey, they're spending money to invest. They're not being reimbursed for that investment into their marketing. They should get some percentage of the pie. Now, that's assuming if they're successful. So on the flip side, they're not successful. They misspent that money. They're probably going to have to bear some level of the loss.
All right. So I think we've kind of set the stage in the big picture about the economic issues and where the value is and what we're looking at. So let's take it down to the more tactical and specifically, what do you tell a CFO or a director of tax that they need to do if this is an issue in their company?
Yeah, So again, going back to the middle market, one of the nice things are the folks that we talk to when we're talking about transfer pricing or commercial transactions are typically business folks. They may be the CFO, they may be the controller, they might be somebody in FP&A, but unlike very large corporations that have, huge tax departments, the middle market typically has operational folks that are handling some components of the tax vertical from when it comes to the business. So they have a knowledge of the business. Where does this value driver sit? Where does the person that makes these key decisions sit? So one of the best practices anybody can do is kind of just sketch out what that is, right? Hey, look, we're thinking about opening up a plant or a distributor in Canada. Okay, take a moment. Tell me about your business. You know it better than I do. Even for your own internal processes, document out where does that value sit? Oh, well, the founder's here in the US and he sits in Chicago and he's the one that comes up with all this stuff. Okay, document it, right? What do you think Canada's going to do? Oh, well, we're just going to sell them goods and they're going to sell it to the market. Okay, where do those customers come from? Oh, well, they're our customers. Like we've developed them. They're just the Canadian affiliates of our current US customers. Okay, document it, right? So tax advisors such as Cherry Becker, we are here to help you, and there is no replacement for a robust sort of transfer pricing report. But even on the smallest end of international expansion, there are things that a company can do that starts putting in place a transfer pricing policy, helping them understand what is relevant, where should the profit sit. Again, tax never wags the dog, so to speak. But having those kinds of proactive thoughts about international expansion will certainly make your accounting team much happier when you're telling them to book entries, but also will make the conversations with advisors such as ourselves and, heaven forbid, conversations with the IRS easier, because you can say, hey, look, this is what we did. This is why we've done it.
So the transfer pricing should really be part of your operations and not just an exercise for tax purposes.
100%. It's something that should be interwoven with your commercial operations to the point where it ultimately becomes second nature. Hey, are we setting up a distributor, or am I buying a UK company that has their own product that I think is going to be a huge addition to our offerings, right? Two very different things, how we think about who should be getting profits that come from the future growth of the company.
Having said that, you still need a transfer pricing document of some sort. So can you at least just give your 2 or 3 minute explanation of what that is and what that process looks like?
Sure. Yeah. So there's something called Section 6662 documentation, or at least that's what tax advisors call it. And the goal there is to provide penalty protection when your transfer pricing, that price that you're setting on these related parties, goods and services, differs from what the IRS thinks, and they make an adjustment or propose an adjustment, and it's pretty substantial from what your revenue allocation was, right? And so having a report to be able to turn it over and say, wait a minute, I just didn't make this up out of thin air. Here is the economic analysis behind it. That's what that serves. What goes into it? Well, there's sort of an industry write-up. There are the factual write-ups specific to the company itself, and that's done through functional interviews, talking to the key stakeholders on the client side or on the taxpayer side, understanding the business, how we identify those value drivers, and then our transfer pricing team uses a set of comparables or benchmarking provided by third-party, kind of database companies that say, okay, hey, look, if you're doing X, this is sort of the range that X should be priced at. And then, of course, they have to make adjustments. They have to say, no, that's not an accurate comparable. Kick that out. This one is accurate, but we got to tweak it here and there. And then they come up with, one, what's the best method to price the transaction? And then what is the actual interquartile range, meaning what's the range of pricing for that best method that the client can then say, oh, yeah, it should be X in that range. And that's how I'm going to price those transactions and those similar like it, right? That's the start of a transfer pricing policy.
Well, when you're talking about transfer pricing, we can't get away from talking about tariffs. Right. And I think, Nelson, you and I have talked before about, that tariffs are not an add-on on top of the transfer pricing, that if we're really going to be thinking about tariffs, you've got to think of them in two different functions, and what are you paying tariffs on, and what are you not paying tariffs on?
Correct. Yeah. So tariffs, right? They're in the backdrop. Probably hard to find international trade where that's not impacted by tariffs. The questions really are twofold. One, which is it a related party transaction like we talked about? If so, that provides an opportunity to think about how to mitigate what the tariffs are imposed on, i.e., what part of that transaction is actually dutable. A lot of the times pre-tariff, right, or lower tariff world, we didn't really pay too much attention to what went into the pricing. That widget was 100x because that's what that widget was. Well, maybe that widget really isn't worth 100x. Maybe the widget itself is something less than 100, but there's other fees that were added into that if you broke them out, wouldn't be subject to the tariff under the tariff rules. So being able to do that as a transfer pricing exercise along with coordination, and we have some law firms we work with that do global trade advisory, global trade consulting, right? Because you got to come at it from both angles. Then the second leg is the refund or the potential refund opportunity that exists. I think that's going to be a very cumbersome process regardless of whether it's a related party transaction or a non-related party transaction. But where the questions, I think, the waters become even muddier is on related party transactions, because people are going to have to identify who bore the cost for the tariffs, I think, right, for the refund. Was it the person that imported? Was it the outbound manufacturer, right? In a third party transaction, you could say, oh, well, I pushed that back on the manufacturer offshore. They ate that. Or I pushed it onto the customers and they paid for it. When you take away at least one leg of that, and you say, well, it's all one business, we're related. Yeah, we may have third-party customers, but if we didn't pass it on to the customers, somebody paid for it. So who paid for it within the company, so to speak? Was it our German operations, or our UK operations, or the US? And how do we think about that? And when a refund happens, how do we allocate that back out? So I do think there's an avenue for transfer pricing when it comes to any sorts of potential refunds in the future, maybe on the front end, i.e. quantifying what those refunds should be to seek them. And then two, how do we actually allocate them if we're successful in getting a refund? But a lot more of that to come, I'm sure, not only with the Supreme Court findings, but if it gets kicked to the appellate to kind of tell what the refund process is, it's going to be a lot.
Well, there's so much uncertainty with the baseline of the tariffs themselves, and then again, we're just taking it to another level of complexity when we're talking about the pricing for the tariff, and then it has a ramification back again on your actual transfer pricing calculations. I mean, it's kind of never ending.
Yeah, I agree 100%. I think the last thing, and I probably should have touched on a little bit earlier, that I would just hang what transfer pricing means to our middle market friends, right? Brooks, you asked me, why is this important, right? We talked about trying to get at the right price, which is truly there because of tax authorities and you want the revenue where you want it to be. From a tax nerd's perspective, why is it important? Well, because ultimately it's going to influence that company's overall global tax liability, right? If you have more profit in a high tax jurisdiction versus a low tax jurisdiction. Also, well, what is that intercompany flow? Should it be a royalty or should it be a service, right? That's going to influence, at least from a U.S. perspective, whether that has what type of source that's considered. Is it foreign source income or not? What type of character is that? Can I use foreign tax credits to mitigate the U.S. cost on that? Flip it on the other side. You go, is that a vatable charge at the local country? Do I get a good deduction for it at the local country? So transfer pricing, while, as Sarah said, is tied to the commercial one for one. When you drill down, you go, well, what's it mean from a true tax compliance and tax planning opportunity perspectives? It is ubiquitous. It's universal across it, right? It influences almost every aspect of any compliance form, as well as what your global tax kind of policy or footprint looks like. So it's just everywhere, and that's what the reasons I think it's so exciting in the middle market as well as the larger corporations.
That's it. Someone else who's equally excited about tax compliance. I love it. Welcome, Nelson. Welcome.
I was also going to just make a brief seg. I mean, when you go to your financial statements, this is typically in the realm of a permanent difference too. When you start talking about tax rates and global rates and all that stuff, so
absolutely,
it can have a meaningful impact on your true GAAP bottom line when you're looking.
Same with valuation allowances too, right, Brooks? I mean, if it's not characterized as something that's going to allow you foreign source income that you of the right type that you can use credits against, you put a valuation allowance up. Next thing you know, you have another hit to your rate. So for those people that are reporting rate and managing at a rate perspective, it's fundamental.
Yeah. All righty. Let's move on to some final comments. So Nelson, anything else you would like to share?
No, I think we touched on a lot of things, and I think a lot of people's heads might be swimming, especially in the middle market space when we're talking about transfer pricing and what's it mean to them. Look, it's got its own language. I totally get it. I think if we always go back to the basics of we're just trying to put the right price on that good or that service between two related parties. It's the role of the advisors, such as Cherry Beckert, to say, okay, let's explain that to you in a little bit more detail, and then also provide a practical approach, because one size does not fit all. Right? You want your most robust as an advisor. You always want to say 66, 62 documentation. That is what you need. But you're going to have some clients be like, I made $100,000 overseas. Right? Like I'm just now trying to grow overseas. So what's the practical approach for me? And then the last comment I would have, which is international growth does come at a cost. I used this analogy the other day, and it's like I grew up in a household of cars, right? My dad was a big car guy. So you're racing a car, you go buy an old beater and you race around the track on amateurs, and guess what? You're doing really well. Fantastic, great. And you go, well, you know what? I think I can improve. I want to go to the next level. Well, just to have table stakes at the next level, now you're buying a fancier car, fancier tires, a car and a truck or a truck and a trailer to tow it in, right? And then you're going to go lose maybe because now you're at a different playing field. I get it. It stinks, right? But there is a level of table stakes when you say, I'm going to expand to that revenue opportunity overseas, but I want to be compliant with it. You're going to have an increase in compliance costs naturally flowing from that. And that's sort of the table stakes of it. And I think it's important that as trusted advisors, we make sure our clients know that on the front end. Tax doesn't wag the dog. I say that a million times. But at the same time, if you're going to pursue global revenue, you have to understand that there's a cost that comes with that, both from an international, but also both from a U.S., but also from a non-U.S. potential compliance and tax costs too. So there are costs with going global, so to speak.
All right, Sarah?
I think one of the things that Nelson mentioned resonates with me, and that is that you have to understand the operations of the company. This is not a tax only or a financial statement or a financial accounting only activity. That's an important part of it, but you also have to understand what is going on with the business. And I think that's where our middle market clients can excel, because there's fewer in leadership perhaps, and they understand more and work together more closely and have a better sense of the operations than in some cases where a larger company might have siloed tax over in a sideline, and they're trying to gather this information from a transfer pricing perspective.
Great.
From my perspective, I still, at least last time I looked, transfer pricing is still the largest dollar in IRS settlements on an annual basis for the most part. So this is not, I try to tell clients when I talk about this is not some little remote hidden issue that nobody pays attention to. I mean, the IRS has litigated and won vast amounts of money on this. Sometimes they've lost vast amounts, but I mean, it's any case, it is not a issue they ignore. And at some point, you cross from that $100,000 profit that Nelson was talking about earlier until you start making more, and then you start getting on the radar. And I'd just say that the sooner you get your processes and documentation set up, the easier it is, and the more tax efficient you're going to be as you continue to grow.
100%, Brooks. The last little plug I'll say is we're rolling out some service offerings for our what you'd call lower middle market companies, or even larger companies that are making their first foray overseas, to help sort of put best practices in place that are maybe not that full 66, 62 robust documentation report, but at least starts putting you on the path towards ultimately getting to the place where when revenue and risk, in the client's mind justify it, that they have already taken a lot of preliminary steps to sort of have that best practices of how to be thinking about transfer pricing. So moving to a full documentation report isn't that far off.
Right. That's a big jump if you go from zero to all the way to the, yep. All right. That's a wrap on today's discussion of transfer pricing and cross-border activities. Thank you for listening in. Quick disclaimer that we are not providing tax advice on this podcast. Please consult with your tax advisor, hopefully at Cherry Beckert, with your specific tax issues or to discuss information from today's podcast. Check out the firm's website at cbh.com for the latest guidance and materials on this and other tax and business topics. This concludes today's podcast. Please like, share, and subscribe. Thank you, Nelson. Thank you, our listeners, for spending your time with us. We truly appreciate it. Let's call it a day and go forth in peace.